For most investors, 2024 was a great year. S&P 500 was up over 23%. 2023 was up over 24%. Your portfolios are likely looking good. The Magnificent Seven top 7 stocks were up over 60%. It was a great year for the majority of people. But what many people might not know is the rest of the market looked a little different than the Magnificent Seven. So we're going to talk to Taresh Batra, VP of Investments at Range, to better understand the details behind these numbers, because there's more to it. We hope you enjoy it. We hope you hit subscribe and join us next time. We're here with Taresh Batra, VP of Investments at Range. So Taresh, the S&P 500, in 2024, it was up over 23%. 2023, it was up over 24%. That is the first time since the late 1990s that it has posted consecutive gains more than 20%. It's what everyone's talking about. What's your reaction to that?
Yeah, it was a great year for the markets. We had strong economic growth. We had rates start to come down, and the markets responded really favorably to that. And we had a great year for the S&P 500. The performance was really weighted towards some of the biggest technology companies, or the Mag 7, which really comprised a big portion of the index at this point. And so they drove the index returns higher.
And when we say Mag 7, it's important to point out, we're talking about the 7 largest tech stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And so when we talk about the average stock, what are you really talking about there?
So the S&P 500 is a market-weighted index, right? And so the bigger the company is, the larger the portion of the index it comprises. But obviously there's hundreds of companies in the S&P 500. And so there are plenty of stocks that are in the index that are not the Mag 7. And when we talk about the average stock, sometimes it's useful to look at the equal weighted index. And that basically gives equal proportion to every single constituent of the index.
So we look at S&P 500, 23%. Mag 7, over 64%, almost 3x. Yeah. Why is that?
The Mag 7 drove the bulk of the earnings growth for the S&P 500. The earnings were just significantly better for those companies than for the average company in the S&P 500. Earnings were nearly 50% higher in 2024 than they were in 2023. The equal weighted index earnings were essentially flat. And if you zoom out for a bit, it makes sense, given where we've been in the rate cycle and with the economy, that the average company is not necessarily doing that well, right? So people sometimes wonder, the Fed has raised rates as much as they have, and we're supposed to be in restrictive territory, but market returns are phenomenal. And the reality is these few companies are being driven, their performance is being driven by obviously massive amounts of AI investments, cost cutting, and just generally they're higher quality companies. They're not as exposed to the pressures that come from restrictive rates. And so when you look at the average company that maybe has more debt or not nearly as much pricing power to be able to pass on higher inflation, they are feeling the pain from restrictive rates. And we saw that in 2024.
Another interesting fact about the Mag 7 was that since November 5th, obviously since Donald Trump was elected for future president, those 7 companies represented over 96% of the S&P 500's increase since that time. So clear correlation with the bullish nature of these 7 companies, with what we're looking forward to when he takes over, when his cabinet takes over in 2025. What are your thoughts on that type of performance, especially late in the year as we head into 2025?
Yeah, I'm not sure it's as much to do with Trump's policy specifically benefiting these companies and more just what's happened to rates really towards the end of the year, right? So as rates have moved up a bit and expectations of future rate cuts have actually come lower, then we're seeing a doubling down in that concentration. People are waiting for some relief, some easing of restrictive economic or monetary policy to allow the average company to start growing earnings at a faster pace again. And so at this point, it's looking a little bit more uncertain or potentially pushed out as to when that relief is going to come. And so people gravitated towards what they feel much more convicted around, which is that these companies, regardless of what's happening in the economic cycle, have just demonstrated that they have an ability to grow earnings, that there's secular trends here that are really strong and potentially counteracting any other economic forces that could be at play. And they gravitate back towards what has been working because they expect that to be safer in this rate environment. And so over the last couple of months, as rate expectations have moved higher, you've seen people go back to the same trade that was working in a higher rate environment. And we're still waiting for signs that breadth can start expanding.
What would be a sign that breadth can expand?
I think data points where the Fed can start getting more aggressive in lowering rates more quickly, or even just having rates come down, even if they are more progressive, and doing it in a gradual way, but such that we feel that inflation is under control and we are going to continue to get some level of stability or downward pressure in rates over time. And we don't have to go through a recession that's meaningful to be able to solve the problem of inflation. And at that point, as we start to see earnings accelerate for the average company, I think you can start to see that breadth expand. So it could just be continuation on the current path, but just proving it, right? Proving it that we don't have to go through more incremental economic pain, that earnings don't have to get revised downwards. If you just look at consensus expectations right now, consensus expectations are for small and mid-cap companies, for instance, to grow earnings significantly faster this year than they did last year, and faster than the S&P 500. So if that plays out, then you should start to see some catch up or increasing breadth, right? Where the market could potentially do fine, and it's not necessarily just driven by the large tech beneficiaries of AI that have driven the market in 2024.
Many investors might look at the top Mag 7 and look at their performance in 2024 and look at their massive valuations, multiple $1 trillion, and think it's top heavy. They're a little bloated, like the valuation's too high. There's nowhere else to go. Then you look at the rest of the S&P 500 and you see a mixed variety of rather large cap valuations. What are your thoughts on market valuations in 2025?
Valuations are basically where is a security relative to how much it's expected to earn over time. And that's often referred to, there's different ways to do it, but price to earnings ratio, right, is the price of a security relative to the earnings. The valuation of Mag 7 stocks has come up over the last year. And a huge part of the reason for that is because expectations for future growth for those stocks is also higher, right? So if we're going to grow faster for longer, then typically you want to pay more for that security. And so it looks more expensive right now. And if you look at the valuation for the broader index, if you look at the equal weighted index, for instance, the valuation there has actually not moved that much, right? So the valuation at the end of 2023 was around 17 to 18 times for that index. And today it's basically around there, right? But the average stock, or at least the equal weighted index, has not seen the same type of movement in valuation. And that makes sense because we're not at a point yet where earnings estimates are accelerating for the average stock. So I think valuation is always a helpful data point. I care a lot about valuation in some ways, and in some ways I don't care at all about valuation. In part because people compare where we are today with history, but it's not necessarily that relevant, right? So the market today, when we talk about the market's valuation, is very different than it was 20 years ago. 20 years ago, the biggest constituents in the market were energy companies, pharmaceutical companies, financial companies, heavy industrial companies. Those companies fundamentally are lower return on invested capital type businesses, and they often come with lower valuations, right? So I'm willing to pay more for some of the companies that are in the Mag 7 because they're higher quality businesses and they deserve higher valuations. And because they're making up a bigger portion of the index seems more expensive, right? And so I think comparison to history is also a little bit flawed, and it's an easy thing for the media to talk about, but I think it's more nuanced than just looking at a multiple today versus what a multiple was 15, 20 years ago. Where valuations are today for the broader market in like the low 20s, it's difficult from here to underwrite that valuations will continue to expand. It is also interesting that valuations have expanded with rates coming up. And so you would think that if rates do come down, that could offer some support to valuations to at least feel like maybe we don't necessarily see meaningful downside to valuations from here. And then it really becomes about what are earnings going to do in 2025.
NVIDIA led the Mag 7, was up over 180% for the year, obviously because of the AI boom. The rest of the Mag 7, whether you consider them AI companies or not, in some way they were all trying to get involved in AI and probably benefited from that surge across the market as well. Let's talk about rates. So we began 2023 up until September of 2023. Rates, the Federal Reserve had rates at around 5 to 550. Okay, we had spent a few years in low rate territory since COVID. In September, they dropped rates by 50 basis points down to 4.75 and 5 range. November, another 25 basis point drop, and then another final one in December, bringing rates down by 1%, 100 basis points for the year, which probably also had a lot to do with Mag 7 performance, S&P 500. There's a lot going on there. We talked about that. What are your thoughts on rates, how it went in 2024, and where we're headed in 2025?
Yeah, so rates started coming down. We saw the first cut in 2024, right? So the tightening cycle, at least came to an end. And for a while, we held steady. And then we started the easing cycle in 2024, which is meaningful. And often you see stocks respond really positively, actually leading into that, kind of like buy the rumor, sell the news, and then not necessarily as positively coming out of those first cuts. So we got the first cut in 2024. The first time the Fed cut, it was a jumbo cut. It was a big cut. It was 50 basis points in response to economic data that seemed was deteriorating pretty quickly. And then the next two cuts that we got were smaller, but in aggregate, again, rates came down by 100 basis points in 2024. And so from here, I think the Fed has signaled that rates should continue to come down. I think that they'll move more gingerly given the state of the economy and the state of inflation. Whether it ends up being 2 cuts or 4 cuts or 1 cut, broadly speaking, though, we're still in restrictive territory and we should start moving lower towards neutral over time. The thing that I always look at is we talked about market performance being driven by earnings growth, right? How are earnings doing? How is the economy doing? Which really underpins what the average company is going to earn. And right now, the economy is still growing, even with restrictive policy. If there is risk to that, and if we start to see economic data points come in lower, and we start to see earnings start to deteriorate meaningfully, there could certainly be some market volatility associated with that. The good news is that the Fed, where they are today, they have a lot of room to start helping. And so if I was to ask you, Tony, like the Fed announces they're going to cut rates by another 100 basis points. Is that good for the market or bad for the market?
I don't know. And that's what I want you to tell me, because I think the average investor might think the market could react very volatile, way up or way down, because that's what we've seen with rate cuts in the past. The most recent one, like we saw the market took a big hit, right? Which I think was contrary to what a lot of people think.
Yeah, I think at that point, the hit was because future expectations for how much they were going to lower came in. And so I think the market was waiting for more and more relief from rates, but they were waiting for that in conjunction with economic growth still staying okay, right? And so I think if the Fed got really aggressive with rate cuts, that would be helpful because that would stimulate the economy. But if they're doing that in response to an economy that's already deteriorated meaningfully, then it really just depends on the timing, right? And whether or not, again, we can actually execute this soft landing, where we bring rates down to a neutral territory, but we don't cause meaningful pain associated with that. And we can still get to that soft landing. We have seen it play out to some extent. It doesn't necessarily have to be smooth all the way down, but it can be soft by the time we actually accomplish the landing.
Yeah, I think rate cuts have become this moment of unease where you really don't know what's going to happen. Obviously, the stock market, you don't know what's going to happen in the economy because of it. But that makes sense. If rates continue to come down, not as a result of some crisis happening, but as a result of slow easing, this continued soft landing as we head into 2025 after 2 great years, it makes total sense. And I think most people would feel comfortable with that.
But the real risk to the broader economy and I think to the market is stagflation, where you have inflation running too hot with an economy that's deteriorating meaningfully, right? So whether it's some kind of exogenous shock or supply shock, we obviously saw during COVID, supply pressures really drive meaningful inflation at that point. Or it could be policy that causes specific inflation moves. And you see that with GDP growth that's slowing. At that point, the Fed would want to help the economy, but they may not actually be able to because inflation is a problem. That's the real risk.
So looking forward to 2025, what are your thoughts, maybe some quick takes as we look forward to the market performance?
If the economy continues to move along at a pace that's not too hot and not too cold, and what a lot of people are referring to as Goldilocks, and the Fed can continue to ease, I think that's a generally good environment for earnings to continue growing, and ideally for breadth to start expanding when it comes to earnings growth. We're still in an environment where you want to stick to quality. We're not at the point yet where we are all systems go, putting fuel to the fire completely and totally on the economy for lower quality companies and every company to benefit. We still are in restrictive territory. That's where rates are today. They are coming down, but companies that have a hard time passing through higher costs, companies that, again, are exposed to higher interest rates, that are just lower quality businesses, they could continue to struggle for the time being. And so I think that quality companies, they don't necessarily have to be the Max 7, but quality companies are still attractive in that way because they can continue performing in this environment. 2 years ago, if you remember, all we talked about was a recession and the impending recession and when is it going to come, and if it comes, how do you react to it? How do you position for it? No one's talking about that anymore, right? Now we're talking about rate cuts, deregulation, things starting to inflect potentially and move higher. If you look at some indicators of the average strategist in terms of how much of your portfolio they're recommending should be in equities, those indicators are at multi-year highs right now. And that's often a contrarian signal. So I think near-term positioning is that generally market expectations are bullish. There's some opportunity for disappointment on that front.
All right, this is awesome. So we really went in depth in the S&P 500, talked about market breadth, really went in the Mag 7, which I think really is top of mind for most people, right? If you're invested in a diversified portfolio, there's a lot of your money that's in the Mag 7. And then really helpful to understand your thoughts on rates in 2024 and maybe where we're headed in 2025. And so with that, we'll be back here hopefully on a weekly basis. We're going to talk about the market, we're going to talk about the economy, and we're going to talk about what you, the investor, want to know and learn more about. So Taresh Batra, VP of Investments at Range, thanks so much for joining us.
Happy to be here, as always.